Hey friends, glad to have you back. Today, we're diving into something exciting. Investing in U.S. markets using ETF. Building a model ETF retirement portfolio involves considering your individual financial goals, risk tolerance, and time horizon. There's no one-size-fits-all solution, but here are some general strategies and common ETF types that can form the basis of a diversified retirement portfolio. Key considerations for your retirement portfolio. Longer. You can generally afford to be more aggressive with a higher allocation to equities for growth. Shorter. You'll likely want a more conservative approach, prioritizing capital preservation and income. Risk tolerance. Aggressive. Comfortable with market volatility, seeking higher growth potential. Moderate. Seeks a balance between growth and stability. Conservative. Prioritizes capital preservation and steady income, less comfortable with market fluctuations. Income needs. Accumulation phase. Focus on growth. Distribution phase. Focus on generating income to cover living expenses while still maintaining some growth. Tax considerations. Utilize tax-advantaged accounts for tax efficiency. Consider tax-efficient ETF fast for taxable brokerage accounts. One more BRK-B. While it's not an ETF itself, Berkshire Hathaway Class B shares are a unique and often considered holding within a retirement portfolio due to their diversified nature and Warren Buffett's long-term investment philosophy. Let's integrate BRK-B into the discussion of common ETF categories for retirement portfolios. Berkshire Hathaway operates as a holding company, owning a vast array of businesses across various sectors, and also holding significant investments in publicly traded companies like Apple, Coca-Cola, and Bank of America. This makes owning BRK-B shares akin to owning a diversified portfolio in itself, managed by highly experienced investors. Why BRK-B is considered for retirement portfolios. Diversification. Although it's a single stock, its underlying holdings provide significant diversification across industries and companies, reducing single company risk. Long-term growth. Historically, Berkshire Hathaway has delivered strong long-term returns, benefiting from Warren Buffett's value investing principles and capital allocation expertise. This can be tax efficient for investors in taxable accounts who prefer capital appreciation over current income. Common ETF categories for retirement portfolios. U.S. Total Stock Market. Examples: Vanguard Total Stock Market ETF. iShares Core S&P Total U.S. Stock Market ETF, significant component of the S&P 500. Holding an S&P 500 ETF. Examples: SPDR/S&P 500 ETF Trust. iShares Core S&P 500 ETF. Vanguard S&P 500 ETF International Stock Market, crucial for global diversification beyond the U.S. Examples: Vanguard Total International Stock ETF. Vanguard FTSE Developed Markets ETF. Next, we should have exposure to bond markets. Bond ETFs. These ETFs provide stability and income, diversifying away from equity market volatility. Examples: Vanguard Total Bond Market ETF. Dividend ETFs. Examples: Vanguard Dividend Appreciation ETF. While BRK offers broad diversification for a single stock, it is still a single company. A broad market ETF offers even broader diversification across many companies and sectors, which is generally recommended for a core retirement portfolio. Sample model portfolios. 1. Growth-oriented portfolio, 60 to 80%. Equities, Vanguard Total Stock Market ETF or iShares Core S&P 500 ETF. 40 to 50% Vanguard Total International Stock ETF. 20 to 30%, 20 to 40% bonds. Vanguard Total Bond. Market ETF or iShares Core U Aggregate Bond ETF, 20 to 40% too. Balanced portfolio. 50 to 60% equities. Vanguard Total Stock Market ETF or iShares Core S&P 500 ETF. 30 to 40% Vanguard Total International Stock ETF. 15 to 20%, 40 to 50%. Bonds, Vanguard Total Bond Market ETF or iShares Core U.S. Aggregate Bond ETF. 30 to 40%. Short-term bond ETF or cash equivalent to 10%. 3. Income-focused, conservative portfolio, 20 to 40% equities. Vanguard Dividend Appreciation ETF or Schwab U Dividend Equity ETF, 15 to 25%. Vanguard Total Stock Market ETF or iShares Core S&P 500 ETF, 5 to 15%. 50 to 70% bonds and cash. Vanguard Total Bond Market ETF Aggregate Bond ETF, 30 to 40% intermediate term bond ETF. 10 to 20% short-term bond ETF or money market ETF. Cash, 10 to 20%. Important considerations. Low expense ratios. ETFs generally have lower fees than actively managed mutual funds. But always check the expense ratio. Lower errors mean more of your money stays invested. Diversification. Don't put all your eggs in one basket. A well-diversified portfolio should include various asset classes, geographies, and market caps. Rebalancing. Periodically review your portfolio and adjust allocations back to your target percentages. This helps maintain your desired risk level and can involve selling overperforming assets and buying underperforming ones. Dollar cost averaging. Invest a fixed amount regularly, regardless of market fluctuations. This helps smooth out your average purchase price over time. Professional advice. If you're unsure, consider consulting a qualified financial advisor. They can help assess your individual situation and create a personalized retirement plan. Remember, this information is for illustrative purposes only and does not constitute financial advice. Always do your own research or consult with a financial professional before making one investment decisions. Thanks for tuning in. Don't forget to like and subscribe. Catch you soon with more fun videos.